Okay, let's introduce the panel, I guess, right? So we have Bart Kelleher from Ardmore, CFO, and then we have Mikael Skov, the CEO of Hafnia, and then Robert Bugbee, president of Scorpio Tankers, and then on the right far end, Ted Petrone, vice chairman of Navios Corporation. So I'll have some slides and I'll show you just a picture, and then we'll try to discuss that. That's the format, and I'll basically ask you to comment and have a question to that. So I don't know, maybe while we're waiting, maybe you can introduce yourself and just talk about the fleet you have, and let's start with Navios Partners.
You're going to start with the odd duck here, because we have a diversified fleet, but since this is the tanker panel, I'll talk about the tankers. We have 47 tankers that we own, 11 are crude and the rest are product tankers. We played a little bit differently, I think, than some of them on the panel here. We sort of arbitrage the time charter market, and we can talk about that as the panel goes along.
Scorpio, how many ships do you have?
We're pure play products. Most of our vessels are in MRs, the medium range, and we have the biggest long range LR2 fleet. Yep. We have everything on, we have 92% of the fleet on the spot market.
Hafnia?
Yeah, so similar story really, pure product tanker play. We own around 125 product tankers, but we also operate another 85 through pools, so well above 200 altogether. And a bit like Scorpio, very spot focused with basically 93, 94% in the spot market.
And then similarly for Ardmore, product tanker focus and chemical tanker focus, and currently 100% exposed to the spot market.
Yeah, this is the first slide. It's just, I want to talk about the near-term market first. So this is just showing you the freight rates, MR rates. For some reason it keeps changing, but the rates have been down from last year, but still very good, roughly 30,000 per day. Yeah, so the left-hand chart shows you the MR rates, right? So roughly 30,000 as we speak, been pretty steady, down from last year. But my argument is that even at 30,000 per day, you have an annualized EBITDA of 8 million. So the right-hand chart shows you, if you buy the 8-year-old ship, which is roughly the average ship that these guys have, the payback is less than 4 years. So, even if rates are lower, it's pretty good, right? Next slide shows you the, current snapshot of diesel inventories in Europe, which are low. And you also have had very good refining margins for a while. It's come down a bit recently, but the backdrop looks very good. So I'll ask you all to, tell us, I guess, on the what do you think about the near-term spot market? So I'll just throw out a few topics that you could discuss if you like. Right, you have the inventories, as I said. Export ban has been in the news. You have had geopolitics, oil prices obviously, seasonal effects, winter is coming, and what's the role of arbitrage? Feel free to discuss what you like. So let's start with Bart. What's your outlook?
I think we have to keep in mind, you're noting the rates like lower versus last year, but still tremendously high from a historical standard. And the fact that we didn't see such pronounced seasonality this summer, and we're building on that base now for a number of the reasons that you noted, and in particular, looking at that diesel inventory level in Europe and how much it has declined, and that we're heading into a winter market. And we have to remember that last year there was that significant build ahead of the February embargo, so we're actually about to see a full winter market where you have Europe sourcing from much greater distances, and I think we think that that's a really powerful catalyst. But I'll pause there and let the other panelists chime in.
Michael, are you feeling bullish?
Yeah, I think, I think we have been basically going into this year, right? And I think in general terms, nothing we're seeing now should really be any surprise. If you look at the past many years, I mean, Q3 was always a weak quarter. Q4 has been stronger than Q3, basically, as long as we can measure. And interesting enough, in Q4, October has actually been one of the weakest months in any case. So we're not, I think there's way too much focus on daily fluctuations in general. We're going to continue to have seasonality and volatility as we go along, right? Just at higher levels. And I'm not so sure that it does anyone any favors when I read all these analyst reports that are reporting every day that MRs have gone up 5,000, down 5,000. It's more confusing, I think, than helping. I think fundamentally, the market has the same factors and seasonalities that we've seen before, just at higher levels. And I do agree with you, Bart, as well, that looking at inventories haven't been drawn down as much going into a winter has really set the market up for, we think, a very, very even further strengthening.
Okay, that's good to hear. Robert, what do you think about the market?
It's fantastic. I mean, it's, as a group, just look at it on the facts. July has been better than June, August has been better than July, September is better than August, and October is starting better than September. That's a pretty good trend, and the world oil inventories haven't got anything, got any better, and now we're turning towards winter. If you were to look at a graph and see that development, and also see that when we started off in July, there was quite a wide spread between the voyage routes that were doing the best and the voyage routes that were doing the worst. Now that has consistently come in much narrower position. So in all terms, that graph on a technical basis is very strong. And as Mikael says, I mean, this is so early. I mean, we're not even, normally for years we've spoken about, a week before, a week after Thanksgiving. I mean, we're only just starting collecting our pumpkins, right? And we're probably going to have our Christmas presents way before Thanksgiving. And the market is like on a knife edge, because it's happened so steadily. And you talk about sometimes Wall Street climbing the wall of worry. Well, I mean, that product market has just kept climbing against any worry that's been there, whether it's more OPEC cuts, whether it's Russia not going to give any oil out. I mean, I think it's only because Wall Street is just looking for excuses just to stay on the edge of the swimming pool. And it's only which week. They're all coming to the party. I mean, all of us are meeting more investors, new investors. The one-on-ones are growing. All our week is just expanding people. So everybody is sort of walking into the party, and they're walking towards the pool. And they're also looking around, waiting to see whether it's okay to take their clothes off and jump into the pool. Well, either someone will lead them in, or there'll be so many people coming on the patio that the people at the front will get pushed in. And that's just when, because the rates, we know that the demand will get stronger. It doesn't matter about what people are talking about recession next year, or the fear on oil demand, etc. What are you going to do between now and January, February? We're not going to stop taking our kids to school. That's not going to happen. And even in recession, the elasticity of demand at the beginning is quite stiff. It doesn't go straight away. And every single oil analyst says we need more products over these next months than less.
So seasonality is the key thing in the short term? Winter? No,
the demand. Sorry, me?
No, he's...
I mean, he's a dry coggle.
He's shaking his head.
You're right. Seasonality can have an effect when the market's tight. If your overcapacity is 5 or 6% and you have seasonality, it's going to be a very small bump. But right now, the market's so tight that seasonality is going to have a huge effect here. And that's what's happening. This is what I love about shipping. These three companies representing to my right play the spot market better than anybody else does. They geographic arbitrage, they product arbitrage, they price arbitrage. We arbitrage the time charter market. We lease it out to others who direct it on a daily basis, and we're deciding what we do short, medium, or long term in terms of where we think we are in the cycle. We could time charter it to Robert or put it in Michael's pool. I think, have you heard the term higher for longer? I think we're higher for longer. I know you asked the short-term question, but I think it's higher for longer.
Okay.
Sorry, I just want to say one. The reason we can do long-term deals, short-term deals. Let me talk about the short-term deals. If we put the ship out for a year, the probability of the ship coming back to a market no worse than it is today is very good.
Okay, let's. So Robert, cut you off. What's the main driver in the near term? It's not seasonality apparently, but
just underlying demand. We're still
demand.
going higher up post-COVID at the moment on a world basis. So that's the first thing. Is you've not just got a movement to the winter season, you've got an underlying strengthening in demand going on too.
Okay.
Already consumption of gasoline, jet fuel, everything else is up this year on year. And you've got a fleet that is, for all intents and purposes, flat. Soon to get less because they won't be able to move around so fast in the winter.
Would you dare to put a number on how high rates could go in this winter period? So if I go back to this chart, like it's last spring or last winter, 60? Could we reach 60?
It's a difficult thing because last winter was such a mild winter. So in one sense, demand could be higher. But as was pointed out, there was also some pre-booking to Europe because of the supply. So you have to balance those things out. I think if the world is a very peaceful place right now with a war going on in Central Europe and one developing in the Middle East, right? So there's no fear of oil supply. So there's no reason why anyone should want to dash out and get their oil. I'm being sarcastic. I mean, it's if you have fear put in there, combined with a normal winter, the rates that you have on your chart don't really, they of course can go higher.
Yeah.
Disturbance in the Middle East by itself would take the rates way above that.
I think if I can add to that as well, you shouldn't forget there's a lot of sentiment in these discussions, right? So basically, if you come from a $20,000 market and it gets tight, then people are happy to get to 25 or 27, right? Because they're afraid what's going to be losing out. The reality is now, the next time the market is tight, people have been used to looking at $50,000 or $60,000 when the market is tight. So there won't be that ceiling where people are going to be concerned about asking for more. And I think that's a strengthening factor. So every time you see these pauses and up again, you're going to have a stronger sentiment every time, right? And that means people are going to push harder. So
to back Mikael, we go back to what's your high on LR2s? What's your high on that one?
This was just MRs, I guess. So
okay.
High was.
But I mean, you have your daily rate on MRs and LRs to do like 40 a day or something.
Yeah.
Okay. We're already getting outliers. Okay. We already fixed at 66,000 today.
Oh, really?
So as soon as you get outliers coming in, that's not what the average is. Okay. But the very fact that you can fix that in August the 10th means somewhere in the world there is a position that is tight, as Mikael says. And trading desks, it's all about fear and greed. So if you have a market already at 40, it is so much easier to push it to 70 than if you had the market at 20 to push it to 30.
Makes sense. Any other comments on the near-term market before we head to the long-term? It's these slides just repeating. I don't know what's happening with this, but
okay. It's entertaining. It's good entertainment.
That's your way of extending the cycle, right?
Yeah.
Just, repeat.
I wanted the long-term picture because the previous panel talked about peak oil. So I just wanted to highlight this long-term secular trend. So the left-hand chart shows you seaborne trade of products as a percentage of the total market. So world refinery output is like 84 million barrels per day. 29% of that is seaborne trade, right? So that means like 70% of the market is local refinery in Germany, whatever, producing for the local market. That percentage has been steadily rising almost linearly, if I can get that slide back again, this one. So even in a peak oil scenario, I guess you could argue for more of the export-oriented refineries taking more of that pie, right? And that is also reflected to the right-hand chart shows you the average miles, which has been moving higher. So that's the great long-term picture, which people like, right? Do you agree with that? And what's your long-term outlook, and do you have any view on this peak oil stuff? I'll just let this slide run.
Well, I mean, if I can maybe kick off. I think what you're showing is actually a pretty good illustration of how we should look upon the long-term market. We've had demand increases, both in absolute demand and ton mile, as long as we can all remember. Every single time the market has been bad, it's because we have ordered too many ships that have come in. And I look at your slide as well that indicates how older ships are having less utilization. So if you look at the market long term, the reality is we have no chance of building the ships that will be required for the next 5 to 7 years, in my view, at all. Not even if we all went out collectively and ordered as many as we could. So I think that's the biggest difference from what you've seen historically, is that it's not because we are more disciplined and we don't want to do it, it's just impossible. And I think that's what people should focus on. It's the supply side that basically dictates that we're in, we think, for a longer run, because all the ships that were built in 2004 to 2009 are now hitting the scrapping age. And they're hitting it at a time where there are almost no new builds, and yards are occupied by other ship types than tankers. And they're hitting it at the time where prices are historically high for new builds. I mean, you want to go out and buy a new build tanker, for delivery in 2027, and you're going to be paying 25% extra just to get dual fuel engines on, right? And the residual risk has suddenly changed because the ship will live until 2050. All of these arguments means that none of us are going out big time and ordering new builds. So I think the supply side is what will drive this market stronger for longer going forward.
Bart, do you have any views on the...
No, I mean, I certainly agree with that, and I think too, in the medium term, I mean, you have the theme that you're pointing out of the incremental refining capacity that's being built in the east. I mean, it's low on the cost curve. The incremental barrel moves to the west. So I think that theme, continues to play out. And one where, and I think the prior panel touched on it as well, there's the practicality of with energy transition, there's energy reality and energy security themes today. And we've seen that reverberate through Europe and other geographies, and I think there's a pragmatism approach that it's going to take a long time to have a transition. So you have this existing fleet that's going to see really high utilization in the medium term.
Ted?
I would say that what drew us to the product tanker industry section after we bought the V's was this ton mile issue that was going back from 2000 and early 2000s. That's been exasperated, as we've said now, that you have more refineries being built out in the east, and the clean's going to come back to the west, although it's going to circulate back out in the east. I do think that the refinery issue is big. I think, remember one thing, it's about, you guys correct me if I'm wrong, about 60% of the clean product that moves over the water is related to transportation. And that's why I think China was so big there. Everybody was running, moving, even though the real estate issue was a problem. I think you'll be seeing the world continue to go out of pandemic. More cars, I know that there's electric stuff, but this thing about peak oil, you just brought it up. It's either tomorrow or 2040, according to who you listen to. I think we should just all remember that it's not a cliff, right? It's just a peak. And it may just drop down slightly. So we don't have any issues. I mean, honestly, we're doing new building deals delivery 2 years from now for 5-year deals with first-class signatures. They're seeing the same numbers we are down the road. So the shorts, right, the major oil players and the major oil majors, they see the same numbers. So they're looking down the road and saying, I just need steel. And so to us, I think what happened is all the people that were moving oil that needed fleets, for the last 10 years, they could have gone spot 95% of the time and they were better off. So the portfolio was 5% long-term charters. That's probably moved to 20 to 25%. That's why there's a lot of interest in period deals these days.
Nearly all renewable projects as a group are moving to the right side of the curve. The US is pretty much of a mess at the moment in doing that. Then Europe has been postponing various things because they've got so expensive and governments are doing things. And, there are a whole lot of countries who are more interested in just getting their economy and people moving around, like South America, India, a lot of the countries in Asia, and these are the customers of the product tanker ships. Remember that the US exports products. Europe isn't really a big factor in the ton-mile part for products. So I think that, that peak or that discussion is obviously moving to the right as well. And to be distracted by that worry at the moment, when you're facing a situation where you more or less got the same inventories entering winter as you had exiting winter last year on one of the warmest winters on record, it's kind of, it's like a dangerous distraction. It's irrelevant. I honestly don't think that any of us in our daily positions are worried about peak oil or peak anything for this point. And the shareholders, let's face it, we can all agree peak oil is not coming in the next 3 years, so we're already well beyond most investors' investment horizons, right?
Yeah, maybe it's a distraction. I don't know, Michael, do you think people who have ordered ships think about this peak oil, or is it something, distraction? Does it matter?
Well, yeah, I'm sure everyone does, right? But I think there's probably also people that are thinking, well, there will be oil moving around in 25 years. And the question is just how much, right? So you can't say there will be no need for tankers in 25 years. I think there will be. So the question is more about, where do you place yourself, right? At the moment, the order book is still limited. So I'm sure people think about it, but, it's obviously also a calculation that if we do think that supply will constantly be less than demand, you have to remember, even when you reach peak oil and it starts dropping, most likely supply will drop quicker than demand. So just because we reach peak oil doesn't mean we're going to have a weak tanker market. That could go on for 10, 15, 20 years. So I'm sure that's part of the rationale as well for people that are ordering ships.
Yeah, this slide is from you guys, Hafnia, which was from your investor presentation. The right-hand side shows you the aging of the fleet, the number of ships turning 20, and which is growing a lot, as you see. And on the left-hand side, you showed utilization of older ships. So that was really surprising to me. Like you can see that there's been a real declining trend in terms of utilization of older ships. What's driving that, do you think, given the strong market?
Yeah, but I think what you're seeing is the beginning of more pressure on older ships, right? And I think we all talked about environmental regulations, etc., and you're now seeing it. I mean, utilization has gone down. And this is even before most of those regulations have hit us hard. So, it's almost like an indirect scrapping that you're seeing, right? So that comes on top of an already tight supply situation that we already talked about. So, I think it's important to bear in mind when you think about fleet development in general terms, that you do have the hidden scrapping already for older ships.
Any other that has any view on this utilization of older ships? What's the impact of the aging of the fleet for this market?
If you go back to that, I think it's been holding, if I'm reading this right, 48, 49, that's because of the war. They'd be down further today if it wasn't for the war and the sanctions.
Mm-hmm. That's a great point.
So this is an artificial number to a certain. Now, if the war ends by the end of this year, which is probably not going to, Europe's not going to go back to a unreliable supplier. So I think that works like that. And let's just say something out loud. IMO has saved us from ourselves because you don't know what the engine to put in. We don't know what the next fuel is going to be. If it wasn't for IMO, I think the product tanker order book would be double. So I think going forward, these older ships become less reliable, and I know there's a lot of issues with the IMO and CII and the EEXI. There's going to have to be some corrections in it, but just remember, I think Lois said it correctly before. Every year it gets a bit more stringent, and maybe if these ships can't even scrap, they're really not going to be tradable because it's a governmental action that laid out these bandwidths. But it's going to be the market that dictates who trades and who doesn't trade. It's going to be money, and are you going to even make OPEX if you're a 23-year-old ship with a bad rating?
Yeah, and we've faced where we've seen the headlines of, oh, the product tanker order book has grown, but to put it in perspective, when you look at that older fleet, and really the zone of ships that will be in that 20 plus scrap age is nearly 40% of the fleet relative to the order book today, call it 9% or so. So I think for the naysayers in the market, certainly to a downside scenario, that actually provides quite an effective floor and some buoyancy overall.
Okay. Robert, do you have any view on that supply side? What's versus order book?
Yeah, I think first of all the order book is a little bit inflated because a lot of those product tankers will actually trade dirty. It's the way that you present the order itself, because every shipyard wants to announce the highest revenue for their own shareholders and their own lenders. So many of the contracts start off with, the price of a product tanker, but inside the contract is the option to actually end up making a crude oil tanker. So I don't think the order book is what it is in all practical purposes. But I think that I agree with all the others. The environmental regulations is getting tougher and tougher and tougher, and that's going to act as a brake anyway on any form of expansion of the fleet. But again, it's another issue where that's the future, long way away, and the present is, it's clear and present right now that the fleet is not growing, the demand is growing, and we're already at quite elevated rates. And as you pointed out, the rates we're on right now, and we've all agreed that, or even less to 2 weeks ago rates, is about a 3-year cash-on-cash payback to equity.
Yeah, exactly. It's very.
So I would prefer to go long the 3-4 year outlook than short against when peak oil is going to come, or when the supply side will overwhelm the demand side.
Interesting.
I just, one thing to go on the back of what Bart said, we look at it a little differently. I think the product side, of 25 to 125,000 deadweight, the order book percentage of the fleet and the percentage of ships that are over 20 years of age is almost exactly the same. I think it's like 9.8, something like that, % for both. So where's the fleet, where's the growth for the next few years? I mean, these guys are absolutely right.
Yeah, the slides have stopped working, but the next slide, you probably, now it works.
Oh, that's not a good one.
The order book, the yard capacity, I think is interesting, right? Because, this left-hand side slide shows you the global order book that has any order, which is down a lot. And I think the product tanker, the yards that build product tankers are probably even lower. So there's going to be a struggle to basically replace all these older ships, right? And as the yards have built up their backlog, there's a clear correlation on the right-hand side with price of new builds, so that's probably going to rise. So what's your view on this new build? There's been, who has ordered ships so far? None of you guys have ordered ships, but and why not, right?
We've ordered ships, but they're covered. I mean, we wouldn't be ordering ships today without long-term cover. We're ordering MRs and LRs, and we've got signatures. Again, I'll go back to long-range viewing. Ships delivering 2 years from now, second quarter earnings. You can see the MRs are getting 23 for 5 years. The LR2s are getting 28 for 5 years. I mean, that's a 7-year horizon. So these gentlemen are fixing much shorter than we are, short term. Obviously, they're doing spot. We're doing short on the time chart of the ships in the water. But, you can get good deals at any part of the market. I mean, if you can go to, we're paying above 20-year prices, right, for assets. But our residual value risk is about 20% after the end of the 5 years. So there are some deals there that can be done. And again, I think the shorts, there's a little panic going on here on some of the major oil traders and oil majors who are looking to think, I need steel down the road.
I think the return factor it's just not attractive to order new ships, even if they're covered, because you're not getting that. The math says you're better off buying a ship in the water, and you will get that return anyway. you'll pay down much more of that with buying a 17-year-old, a 7-year-old or a 5-year-old ship. And something even better than doing that for most of us would be buying your own stock. Now there may be exceptions where you may be doing things with partnerships with certain partners, for example, who are willing to do things. But that's just generally what the mathematical position is. And that, I think, is fundamentally where I think you've got a different generation now. I think most of the managements are conscious about return on capital to shareholders and the value of what they're doing. They don't need to necessarily spend money. I mean, each of our fleets is slightly of different age, but they're certainly young in comparison to the general market. So the math says that it's just not a big enough return to order new ships for far out delivery. And that will get harder and harder, because this is where it does matter, because just maybe your dynamic changes in 2030 or 2028 or 2029 and you start to shift, just maybe. And so therefore your risk of ordering a new ship delivering 26, 27 is much more expensive and more riskier, because you've got money down and waiting, than it is to do something prompt today. That's why I think they're not ordering, along with all the other factors of we don't actually know what fuel to use for it.
Mikael, do you agree?
Yeah, very much so. No, I think that's also our view, and hence why we've kind of stuck to look at secondhand as well.
So what would need to, I guess you need to have long-term cash flow or something like that to order a ship, to de-risk it. Is that the way to think about it?
Yeah, and I think that's, as Ted said, I mean, I think we've all been looking at some of these deals, right? And there are a few deals here and there that you can do with 5-7 years, but they're all special projects rather than, just a regular product tanker. And, as I said earlier, I think in order for new builds to go up in activity, I think you need to get to a level where people have more visibility and more faith in the very long-term view of oil demand and supply, right? And I think we're getting to that point now where it becomes more evident that that spread is there to stay. And I think at that point, maybe some people will get more confident about it, but I agree with Robert right now. It's actually about having ships on the water.
Yeah. The last topic is the macro backdrop. I mean, when I talk to investors, people like this story, right? It's easy to look at the order book, aging fleet, oil demand, this long-term trend. What holds people back, I guess, is fear of a macro event, recession, and expensive stock markets. Does that impact your own decisions when you operate your company? And also, if you look at this left-hand side, you see the price to NAV historically. I guess all this is embedded in that valuation, right? And so how important is this low valuation when you do make decisions on capital allocation? Let's start with Bart.
Sure. I think, when we're going through the interest rate cycle, and certainly the views of higher for longer, a theme of I think all of us have delevered. We're lowering our break-evens. You're making the companies stronger for the next cycle. I think as we've talked about, like the supply scenario is such in the starting point for demand today, that if you have a wide range of views of potential forward demand, kind of looking ahead, it still is a very net positive story. And I think that makes it unique from kind of our starting position today, and going back to allocation of capital, and the discussion of new build versus secondhand. I think it also then comes to that there's a key story today for investing in your current fleet, and above and beyond what you would be required for regular capex to make the vessels more efficient. And those incremental capex projects, typically it's very short payback, 1-2 years, very, very high IRRs. And so we see a continued pathway for that as well, while at the same time being able to return capital to shareholders. And I think that, through stronger markets, really building on that track record.
Yeah, so well, first and foremost, I hope that we'll get a little bit away from this price to NAV as we go along, right? Because I think that reflects a historical view on our business that was really based on shorter cycles, and therefore naturally it was tough to give you a multiple on earnings because you always saw these cycles change quickly. I actually do think now that the time has come, for all the reasons we talked about, that you should think more about a multiple going forward. So that's kind of my comment on it. I mean, I think like anybody else, I think we've also been focusing quite a lot on investing and building, and now it's really about more returning capital to shareholders where we are now. So as I said, I mean, I do believe the time has come to look more on forward earnings than maybe price to NAV.
Robert, you mentioned earlier that there was a lot of interest of investors. You had double bookings and up here. So what's your feedback?
My feedback is what I said, is that lots of people are standing around the pool waiting to wonder when they should jump in, because the investors are fundamentally intelligent people. They can do the math probably better than we can on the returns on the present rates, etc. But you've got to have a little bit of sympathy that right now, there's a lot of things to worry about in the little picture. When you talk to us how confident you are in the product market, that little picture product market, super confident. How confident are you of the general world finances and economic position? Starts to get a bit grey. You have to have some kind of respect for the fact that it's going to be pretty unpredictable what could happen in the Middle East. Now, from shipping, most of those things are actually positive to the rate structure, regretfully on a humanitarian basis, but the same as the Russian war is, but it still puts some unpredictability and shake-up in there. The next is that, not everybody's having a great year in the stock market. We're coming to that sort of funny time. And the next part is that it's just that. They haven't had much information. I think they need to have the third quarter results. I think they need to see the rate structures that are developing so far for October, November bookings. And it might well be a case where this thing continues until you just get forced capitulation when the rates actually move. So I don't think we should be worried about, or even actually care about, the movement of the stocks on a monthly or 2-monthly basis. I mean, even this graph in a way shows it. It shows the extreme falls, in 2011 post, the crash. And then you see another one in 2021, which is obviously, COVID related. I actually think in reality, the stocks were trading pretty much in line with net asset value. It's just that there were so few trades done, no one had to actually take the values of the ships down. If you actually were a forced seller in that period, I think you would have found the stocks would have been pretty close to real net asset value. So I think that what we're in one now, right now, where the financial uncertainty is overwhelming the actual industry fundamentals, and that in strong rates cure everything. If we have strong rates come Thanksgiving, the stocks will be up. If we don't, the stocks will be down. That's it.
Okay, good. Ted?
I think you talked about the concerns about the macroeconomic environment, which is very challenging. The geopolitical landscape is even more challenging these days. Our answer to that has been to diversify our fleet under one umbrella and have counter-cyclicality that allows us to do short-term deals, like Robert says, which are probably the better deals, and do the longer-term deals for long-term cash flow. So, but I think on the product side, I mean, everything's flashing green going forward. I can't, you try to poke holes in it, right? And everybody's groupthink is good, so that scares us, right? So we're trying to poke holes in it. It's very difficult at this point.
Yeah, I don't think the groupthink is good, because the stocks are showing that groupthink is not good. The stock prices are showing that groupthink is really worried and doesn't buy into the cash flows that are coming. But as I said, that's fair enough. There's no complaint.
Okay. Great. On that note, let's wait for Thanksgiving and see where it's are.
Yeah.
Thank you very much.
Thank you.